Dear investor, in this edition, let us discuss the following. First, start of the Fed rate cut cycle, that's the news of the day. Institutional flows and supply of paper. Third, risk factors that we see today. Fourth, we continue to believe in that this is time for alpha. And yes, valuations. Now, on the first topic, Fed rate cut cycle has started. We will look at the impact of global growth outlook and changes on India. Now, inflation has been coming down globally. Developed world has embarked on a rate cutting cycle. Amongst advanced economies, Switzerland kicked off the rate cutting cycle first in March of 24. Subsequently, other major central banks, ECB, Bank of England, Bank of Canada, Sweden, also started their rate easing cycles. US Fed has now joined the expanding list of central banks that would have slashed interest rate, having done so on September of 18 with a 50 bip reduction in Fed rate. Only Bank of Japan has hiked rates twice before and may hike again soon. The rate cuts signal a belief that inflationary pressures are under control and cuts are required to support the labor market. The dot plot, which represents the committee members' forecast for the federal funds rate, indicate an additional 50 bip cut in 24 and a further 100 bip cut in 25, reflecting a continued easing of monetary policy. Now, in the US, price rise have slowed to an annual pace of 2.5%, not far from its target of 2%. Now, with oil prices sagging and housing rents rising more slowly, there is a good chance that inflation will ease further. Hence the Fed's worries may have shifted from inflation to the job market. The unemployment rate of 4.2% is low, but nearly a full percentage point higher than early last year. Unemployment could rise further as companies have pared back their hiring. Real estate sector in the US is seeing some signs of topping out. Now, this rate cut cycle is not in response to any large event or a crisis, but a response to loosening labor market and lower inflation. It thus should not cause any concerns to arise. A rate cut cycle is good for emerging markets as more money flows into them, seeking growth and higher yields. Currencies stabilize, forex levels improve, bond yields reduce, and stock markets are generally more buoyant than otherwise. Now, while that is on the emerging markets, India should be influenced relatively less by happening in other economies, especially since our forex reserves are already at an all-time high and bond yields have already started to decline. But yes, coordinated global cuts should provide tailwinds to these trends. Now, expectations of a rate cut in India would also increase, and we expect the first rate cut over the next 3 months. Now, while growth assets such as equities benefit from decline in interest rate in terms of levels, different sectors in equities can behave differently. For example, decline in regulated rates is not good for banks because it pressurizes names. Stronger earnings growth spaces should get tailwinded as growth money comes into the market. So, we do believe there could be some change in the style leadership in the market from value. This events could make growth stand out in the future. This happened in the past. A drop in yields coincides with growth style of investing getting into the fore in the markets. Our portfolios have been, if you look at how our portfolios are constructed, we have been underweighted banks and have a very high earnings growth orientation, and we believe we are very well placed for the rate cut cycle. Now, on the next topic, institutional flows have been quite consistently positive. But while this has been happening, supply of paper is also increasing. FPIs have been very consistent buyers in India, more consistent than they have been in other geographies. Over the past 18 months, there have been only 5 months where we have seen net selling by FPIs. The rise in India's share in global indices has provided a virtuous loop, and now Indian weight in some MSCI indices is close to and even over China's weight. India has stood out amongst emerging markets over the past few years, while other emerging markets have generated meager returns. Returns from Indian stock markets have provided to be much more consistent and robust, and has been amongst the best. This has been noticed, and our markets are becoming less correlated to the world. Indian markets have offered strong results, and we are now providing better liquidity, justifying the purpose of diversification quite well for a global investor. Now, mutual funds have received inflows very consistently. From March 21st onwards, there has been no negative month of inflows on the mutual fund side. Insurance flows have been more patchy. There is a strong flow and interest seen in insurance from December to May period, and less during other periods. Consistent flows and institutional interest has increased the depth of the market. While markets have remained buoyant, IPOs and QIPs have begun to flood the market. In many months, the flood of IPOs and QIPs have matched the inflows into mutual funds. The money raised is continuing to rise. There is a virtuous loop here. This is supported by new investor additions into the market. New issues are the chosen way for new investors to come to the market, and we have seen over 40 lakhs of them getting added on the trot every month. So our belief is, as long as new issues continue to make money for investors, this virtuous cycle may continue into the future. Coming down to the next topic on risk. Now here, let's look at various variables that impact India. Many of them are favorably placed. Oil prices are low, forex levels are increasing, and now global rate cuts seem to be all coordinated, as we discussed before, and these are all very positive for India. Increase in yield by Bank of Japan induced a round of volatility last time it happened, and could do so again. So that's a risk. However, given the low exposure of Japanese investors in India, for them and for us, any such drop should present a buying opportunity. Coming down to the next topic, this is time for alpha. We have been covering this in various cuts, various facets over several of our videos. One source of alpha creation in the market is advent of newer spaces with strong growth outlook. Markets follow earnings growth is the key belief. Hold that and a lot of things get clearer. Since the new space is not represented in the indices, they offer potential of alpha creation. The current period has been very disruptive for earlier large incumbent businesses, as technological changes have been rapid. Just like advent of online stores gave huge competition to brick and mortar stores in the past, EVs are giving, for example, large competition to ICE. In some spaces like two-wheeler, the entire change from ICE to EV could happen in, let's say, a space of 10 years. The past period saw the launch of first pure EV two-wheeler company on the bourses. Now, while the incumbents face a daunting task of preserving sales from legacy products, which can, slow down response to the adoption of newer products. On the other hand, newer businesses, newer companies which have come into being adopting emerging technologies face no such issues. It is an opportunity for them, especially when they have crossed the proof of concept stage and have a good balance sheet. So, sustenance is no longer an issue. Now, we have aligned our portfolios with such businesses in the new emerging spaces. To give a few examples, new age tech and digital, electric vehicles, renewable energies, defense, luxury consumption, beneficiaries of unorganized to organized, etc. This gives us our high earnings growth orientation. Now, coming down to the last topic on valuations. Valuations on large caps are at 10-year average and are very sustainable. This is the time when we can argue that valuations should be higher than long period average, as growth in earnings remain higher than long period average and discount rate has started to drop. In valuations, only two things matter: growth and discount rate. Both are moving in favorable directions. On DCF, a 1% higher earnings growth for 10 years is a 5% higher PE valuation. This is the thumb rule, one can use it. On this measure, mid caps are today building in, mid cap index is today building in 11% higher earnings growth versus large cap, and small cap index is building in a 3% higher earnings growth for a period of 10 years versus large caps. Now, while this may seem too much, especially in the context of what has happened up till 2020, we believe this is sustainable, especially because many of the new growth themes that we spoke of are present more in the mid and small spaces. Thank you. Happy investing. May the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.